Ladies and gentlemen, welcome aboard the Pilot Money Guys podcast, where our mission is to help clients build and protect wealth to achieve their dreams and goals. This podcast is brought to you by Leading Edge Financial Planning. Without further ado, here is your host, Robert Eklund.
A tip of the cap to you, and thank you for joining us here on the Pilot Money Guys podcast, Flight 65. On this podcast, we usually talk about flying and the aviation industry, then throw in some good old lighthearted financial fun. However, today the financial fun is going to take front and center court. I'm your host, wealth manager, and airline captain, Robert the Rubber Mallet Eklund, and I'm joined by investment guru, Naval Academy graduate, and former F-18 pilot, Andy VizCap Christopher. Welcome, VizCap.
Good to be here.
Now, folks, if you're listening to this, you're in for a real treat today as we have a very special guest joining us. This man holds a PhD from the University of North Carolina, an MBA from Wake Forest University, and a BA in economics from the University of Delhi in India. Our special guest has taught at both Emory and Purdue universities, and his research includes public equities, fixed income, and private equity, among many other topics. Formerly, he was a consultant to Dimensional Fund Advisors and AGO Partners, and is now a consultant at Avantis Investors. Ladies and gentlemen, boys and girls, put your hands together and let's welcome the Jack D. First Professor of Finance and Director of the Center of Investment Engineering at the W.P. Carey School of Business at Arizona State University, Dr. Sunil Wahal. Pause for applause. Welcome, Dr. Wahal, and I won't call you doctor anymore, I promise.
Yes,
and,
nobody calls me doctor. Even my kids don't call me doctor, so please don't.
All right, sounds good. Now, as you probably don't know, Sunil, here we give each of our guests a call sign to commemorate their presence on the show since we're pilots, right? So bear with us for a second, but clearly you know what you're talking about and how to communicate your thoughts in an eloquent manner. When I somehow stumble upon making a good point or an eloquent point in my household, my wife will call upon me to do the smarty pants dance. So thus we have decided, and by we, I mean me, we've decided to give you the call sign of Dr. Sunil, the Smarty Pants Dance Wahal, or SPD for short, whichever way. So apologies on that, but thanks for bearing with us.
Well, I'm going to pause you right there because I share a fantasy football team with my daughter. And
nice.
For many years, that fantasy football team, for the football fans among the pilots listening to this, was called Smarty Pants. So
no way.
Right in.
There it is.
It's in the air.
It's destined.
It was. Oh, that's fantastic. Well, welcome to the show, Dr. Smarty Pants Dance. And we just are thrilled to have you on. Obviously, I was reading your bio there, and it's quite the bio. But you have some great ways of thinking about finance and making it interesting to listen to. So we were talking in pre-show prep there. You have a wonderful way of walking through some important topics for pilots. So I'll just kind of give you the floor, and you can hopefully help us out a little bit.
Yeah. So I think many people, when they think about investing in general, somehow want to disconnect it from life. And I don't. To me, investing is part and parcel of life. And you have to think about it in that context. And most people think about investing in the form of financial investing. I don't think of it that way. And certainly when I talk to students or investors or clients, I try to get them to think about it in a more holistic way. So for example, if you decide to take a continuing education class, that's an investment that you're making that you hope has some payoff in the future. If you decide to go work out, well, that's an investment that you're making for some payoff in the future. Maybe, a really healthy heart, not a backache, et cetera, et cetera. So I think of investing in sort of a more holistic way. And the principles by which we think of investing in financial markets are really no different from other forms of investing that we make on a day-to-day basis. We just do it in a very intuitive way. And in financial markets, you can sort of formalize things and be a bit more, shall we say, precise about how you can think about things. that's kind of the way I think about it. And it's especially true when I talk to students and clients. I encourage them to think about investing as deferred consumption. We all want to consume. And if you're investing in the future, that means you're not consuming today, or you're hoping to consume something in the future. You save today to consume something in the future. And I think that if you can get people to think about investing as deferred consumption, the starting point is not how much money can I make in, XYZ investment. The starting point is, what do I want to consume in the future? And when and how? And that's a different mindset. And it forces you to think about investment in a very different way. Does that make sense?
Absolutely. I love it. Matter of fact, one of the things I do with my clients is when we start talking about this kind of stuff, the term nest egg comes up, and I throw my hands up in the air and I say, no, it's not a nest egg, because we want to protect eggs and nurture. It's deferred spending. But I like deferred consumption even better.
Yeah. And there's smoothing we do, right? So for example, and people can overly smooth future consumption because, I you can't see the gray hair now, but when I was younger, I would think about, okay, what do I want to do? Well, one of the things I really wanted to do in my life was, see all 7 continents. That's not an easy thing to do. Maybe it's easier for pilots, and pilots can probably appreciate this. But I wanted to see and go to all 7 continents. And that means spending that money earlier in life, because if I'm too old, I'm not sure I'll want to go to that 7th continent, or how expensive or difficult or physically will I'll be able to do it. And so it requires a thought process, like a very careful thought process. Is, do I really want to do this now, or do I want to save for that nest egg? That nest egg is useless if I can't get to my 7th continent when I'm 85.
Right. How far are you on your continent list?
I'm done.
You got Antarctica.
Yeah, I did. I'm done. I'm thrilled to do it. I think pilots listening to this can appreciate it. I love travel. We have traveled extensively as a family. My kids have traveled extensively. They're in their early 20s now, and they've probably covered, I don't know, north of 25 countries. So
wow.
It's not easy, but you make those decisions, and it's now or later.
Fantastic. I love it.
I love the deferred consumption. I think about is Warren Buffett. They talk about the $200,000 haircut. I'm probably butchering the quote a little bit. I don't think Warren Buffett goes to sports clips like I do, so mine's probably a $50,000 haircut. But
we can tell. We can tell, Andy.
Yeah, exactly. the idea is, obviously you don't spend today, and that can grow into something tomorrow. And the other part there is the human capital component that you mentioned, right? Not just investing financially. And I think about pilots, and I think about how should I think about my risk tolerance and risk capacity as I go through my career? And we've got these great questionnaires that clients fill out. And I always wonder, how do those capture, right? Of course, it's right now. We're not in the throes of a financial crisis. How good are those at even capturing that risk tolerance and risk capacity that someone is capable of taking?
I think that risk is a very, very important part. Risk preferences or tolerance or risk aversion, if you will, is such a critical part of investment that I think that the best advice often you can give, students, investors, clients, even my own kids, is know thyself. You really have to know yourself. What risks are you willing to bear? What risks are you not willing to bear? How do you calibrate those risks? In economics, we formally sort of stick all of this inside what we call a utility function, which, anybody who's taken Econ 101 will learn about utility and roll their eyes and say, oh my God, another academic construct that we don't care about and that is disconnected from the real world. The answer is it's not really disconnected. it's a very, very useful framework for us to think about investing and for us to think about risk. I think pilot situations are particularly interesting and unique. I think that because their human capital is tied up in such a unique way, unlike many other professions. The mandatory retirement side, the risks that they take on getting on a plane every day, not that it's all that different from a lawyer going into their car driving around, given how risks have been managed, but health issues, et cetera, the risk aversion and the expenditures that the future expenditures that they have are very unique to pilots. I think they have to think about those things carefully. I mean, if you start to calibrate, so the mandatory retirement age is an important part. That doesn't mean you won't have labor income or capital after 65, because pilots can retire and go do other things. But I'm not sure you want to count on it. So that's really important. I remember back in 2020 when we were in the midst of COVID, and I'm sure you guys remember this, like you could look at the stock prices or the credit default swaps for United and Delta and all of these airlines. And all I can think of, and I think I use this as an example with students, is if you're a pilot, you really better hope that your investments are well diversified out of airline stocks, because you really don't want that risk concentrated.
Yes. I love it. So many of our pilots, we have profit sharing plans, and many made a lot of money investing in whatever airline you're with. A lot have lost a lot of money by having too much risk there. Yeah.
So, when we tell people think about your portfolio, we don't mean just your financial portfolio, your human capital portfolio. And your human capital, if you're a pilot, is so closely tied to the airline or airline securities in general that first rule of business is diversify, diversify, diversify. So your financial portfolio shouldn't be touching this. In fact, if you asked me to design a 401k plan for airlines, it would be everything X airline securities, because that's the right thing to do. I mean, we know that from financial science. I'm not entirely sure why vendors don't create that, but they should. It's a straightforward thing to do.
Fascinating. It's something that I think a lot of people don't think about is that piece where what are you doing, and do you have too many eggs in that basket, not just with your money, but with your life?
Yeah. I think that's absolutely true. When I think about these expenditures in general that people have, they have really three kinds of future expenditures that they think through or try to think through. There are some, predictable recurring expenditures like your mortgage, right? You're going to have mortgage payments for X number of years. It's recurring, it's predictable. When you make your investment decisions, you can plan for those kinds of things. Then, so those are recurring. You can also have episodic, non-recurring sort of big expenditures that come up in your life. And they can be inflows as well. They don't have to be expenditures. And then the last part is the hard part, which is, you're going to have unpredictable, we call them in economics, we call them shocks, but there's no reason to call them that. Unpredictable cash flows, either inflows or outflows, that happen to an investor, right? So unfortunately, somebody passes away, and in their legacy, in their will, they leave you a large chunk of money. So that's a positive inflow. But you go through a health crisis, that's a negative outflow. It's pretty substantial sometimes. You can't forecast for those, and so in thinking about investing and that unpredictable consumption in the future, that outflow that's going to take place, that causes investors to change how much risk they're going to take on. And for a pilot, that means, generally speaking, pilots ought to be a little bit more risk averse than the average investor, because they have more of that. And then they have mandatory retirement, and there are other aspects to their human capital that basically make them a little bit more risk averse, at least on average.
Yeah, that's a great point. And along those same lines, right? The pilot who has to get I think at least a year a medical exam, right? And so that can change on a whim, right? Or something happens there, and now all of a sudden your main source income is totally gone there.
It's like an insurance demand almost, right? Andy, does that sound about right? It's an insurance demand. Like, something bad could happen, and it's more likely to happen to you than a random person on the street. Absolutely. And so you want insurance against that, and that's going to cause you to be a little bit more risk averse than everyone else. And that has to get reflected in the asset allocation that you build in your financial plan.
Yeah, it's super important. Sorry, go ahead, Eddie.
No, I was just going to say, I think you just opened the door wide open. So asset allocation, right? And I think that phrase, especially in the financial advising world, gets tossed around pretty easily. But for someone who's, going to go out and do it on their own, and they think about like, well, stocks, bonds, right? Like, what should I even put in this, portfolio to build? I mean, just kind of like, what are the building blocks that we're thinking? Obviously stocks, bonds, but it goes so much deeper than that.
Asset allocation can be a really hairy and difficult proposition for the average investor or the average pilot. I mean, it can be really pretty tough. If you make the mistake of Googling, for example, asset allocation or what is an asset class, I think you would get answers that would overwhelm the average person. They would look at it and say, oh my God, I don't know heads from tails in all of this. It's really, really tough to understand. And part of it is because the design systems and nomenclature that we use for what is an asset class is incredibly complicated and not very primitive. Andy, you hit the nail on the head when you talked about stocks versus bonds, because really those are the two primitive asset classes. There's nothing else. So, I tell students, think of the world as a balance sheet. The left-hand side of the balance sheet is assets. The right-hand side has to equal the left-hand side. And the right-hand side only has two things in it, right? Debt and equity. And when you think about asset classes, there are only two asset classes, debt and equity. Now, within debt, you can think of government bonds or corporate bonds or whatever. And in equity, you can divvy it up as much as you want, but that's basically it. So from an asset allocation perspective, that the debt side, the debt side, the liability side is less risky than the equity side. And so you want to really mix and match to be able to meet those future consumption needs. So in principle, it's really straightforward. In practice, it's hard.
Absolutely. Circling back a little bit here on the risk and how we think about that. That's one of the big things that we do, I think, is solid planners are trying to do for pilots in particular is solve that medical question with short-term disability, insurance type backup, long-term disability, loss of license. All of those things are so critical. Usually those are discussions come up at the beginning of the relationship rather than later because they are so key. Thinking about that, a lot of our folks have a military retirement, so that helps with maybe the debt equity solution to be a little riskier, as you might say, but not always, for sure.
Yeah, it's not always going to be the same, and it is a function of what you want to consume in the future. So, if you have your future consumption plans well thought out, like if you sat with a financial planner or a financial advisor and say, here's what I think my world is going to look like. It doesn't have to be perfect, right? It just has to be a decent enough forecast of here's what my world's going to look like in the next 30 to 40 years. Then you can reverse engineer, okay, it's not going to be precise, but reverse engineer is what my asset allocations ought to look like. Even in a very simple, basic term like debt and equity or stocks and bonds, that's it. I mean, if you go down the rabbit hole, there are so many asset allocation models. There's fancy, like really mathematical optimizations that we do for asset allocation. People will talk about the 1/n rule, divide everything up into equal proportions. People will talk about 60/40, which, some magician came up with. It doesn't make it perfect. But those are all crude approximations. And the starting point really has to be, what is it you're trying to achieve? What are your financial goals? And then the asset allocation plan is a way to get you as close as possible to those future financial goals. So if you don't know what those goals are, then asset allocation is, basically a crapshoot.
I love it.
I think yeah. I think maybe I'll jump into the active, passive, or really just performance chasing discussion a little bit along the lines of asset allocation, right? Because if I'm that investor staring at the precipice of like, well, what should I pick? Even if we start talking just on the equity side, maybe a common tendency would be like, well, who did the best last year or last 5 years, right? And then that's where you put your money. And I think to Robin and myself here, we know that maybe isn't the best way to go, but just get your perspective on like how do you make those decisions, right? Because that's a logical approach to take, I think, for a lot of investors.
It's a default approach for many investors because there are these tendencies in human beings to extrapolate. We love to do this, right? So, I talked about fantasy football. If you look at people who draft fantasy football players, the one who's done really, really well recently is hot on the trade market. And, you can pick your sport, pick your investment, whatever it is. People like to chase winners. It's just part of the human psyche. That's
how I got married right there.
Yeah.
I hope Jana's listening right now.
Sometimes it works. So asset allocation done properly and rebalancing fights against those tendencies in a very significant way. So let me give you an example. Let's suppose you have a pilot and the pilot is doing their asset allocation themselves, and they say, look, crypto has done really well, or the latest AI index has done really well, and that's what I'm going to load into. What are they doing? They're chasing winners, right? An asset allocation plan that hopefully done properly is designed to meet their future financial goals and needs is going to do the exact opposite when it rebalances. So let's just take a very simple example. Let's suppose their asset allocation plan is a 60/40, 60 in stocks, 40 in bonds, right? That's all, nothing else, simple. And stock markets go up relative to bond markets. So that means that future weights are no longer 60/40. They've crept up to something like 70/30, right? What a rebalancing plan and a thoughtful rebalancing plan will do is it'll say, no, your target weights ought to be 60/40. So it's going to cause you to sell some of the things that have gone up in price, right? And buy some of the things that have gone down in price. So it's the exact opposite. It's contrarian. Why is that useful? It's really useful because we know from financial science that as a general rule, when prices go down, that means future expected returns are high. So rebalancing really, really helps investors' portfolios going forward. And sort of as an added benefit, it fights this tendency that people have, say, chase winners. So done properly, rebalancing makes a ton of difference to investors' portfolios. It's one of the most valuable things, I think that financial advisors do for their clients. It helps them so much because it solves many problems at the same time. And done thoughtfully, it can help on the tax side as well.
Yeah, I think that I appreciate you bringing up the rebalancing side there, and you said something that was done properly because it seems so easy, right? Just oh, sure, yeah, I'll rebalance, and then of course, if you look at there's a lot of literature on rebalancing. Should you, a Vanguard, I think maybe say just do it once a year. It doesn't really matter, right? And then you have others say, well, it enhances returns. I mean, how do you think about rebalancing? If I'm an investor and I'm just, is it quarterly? I imagine it's something that just forces you to stay disciplined and systematic. But what's your perspective on that optimal approach, if you will?
Yeah, I think that the way I think about it is the way I think about all of my decisions, not just rebalancing decisions. I ask myself, what are the costs and what are the benefits? Now, if I rebalance, so let's suppose I rebalance once a year, this so-called Vanguard approach you were describing. What's going to happen? So pretend we're in March 2020. Nobody wants to pretend we're back in March 2020, but indulge me for a second. So markets have gone down quite a bit. And because markets have gone down quite a bit, you know that expected returns on equities in particular are quite high. That's a sensible time to rebalance. And your portfolio weights in the asset allocation plan have really changed a lot. But if you're going to wait till the 31st of December because some arbitrary ruler said that's when you're going to do it, you're going to miss all of that. That makes no sense. So calendar time, I'm not a big fan of calendar time rebalancing for investors, with one exception. And the exception is we have lazy investors. They're investors, or maybe that's the wrong word. Let's not call them lazy. Inattentive investors. Busy investors, right? They have lives to get on with, life comes in the way of this. So if they don't have a financial advisor, if they're doing it on their own, then they're not paying attention in March because they've got bigger things to deal with. When the house is burning down, last thing you want to do is rebalance your portfolio, right? It's not important. If you have a financial advisor, they should be doing that. If you do have the time, then I think that instead of calendar-based rebalancing, threshold-based rebalancing makes a lot more sense. When those weights change from 60-40 to 50-50 or 70-30, that's when you should be doing your rebalancing. Now, the obvious question that I can forecast somebody is going to ask is, well, if your target weights were 60-40 and they go down to 59, should you do it then? How about 58? How about 57? Well, the answer is every time you rebalance, it's going to cost you something because you're going to have to buy and you're going to have to sell. So you really don't want to do it for every tiny little increment, right? So you set up a threshold, say, if prices move by a certain amount, then I'm going to rebalance. So I'm going to tell you what I do personally in my own account. So I'm a lazy and inattentive investor as well. So because, life goes on and life throws things at you. And so you don't always have time to do it. So I do it probably twice a year when I have to think about taxes. I probably have to think about taxes, and I should think about taxes more than that, but they're boring and not fun to think about, honestly.
I'm so glad Kevin's not here.
So I do it at least twice a year. I'll look and see if I need to rebalance. But because I also have to pay attention to financial markets because of my job, March comes along and say, well, I'm going to rebalance. So that's what I do. It's like a little bit of a hybrid, and I pay attention to the cost. I'm not going to do it for every little increment, but if prices move sufficiently, 2008, March 2020, et cetera, if I see those kinds of things happen, I'm going to rebalance because, I'm classically trained. I know what it means for expected returns, and I'm willing to bear the risk.
I love it. And, we all have heard that and have said that behavior drives higher expected returns. However, I always throw in good behavior drives higher expected returns. And it's one of the things with people and clients that it feels good when things are going awry. Hey, I can actually do something. And rebalancing is a good behavior to do when things are going bad, and buy stocks at lower prices. I love it.
Yeah, I'm a huge believer in that, and I also use those opportunities to, Andy, you mentioned the whole active versus passive thing. I use those opportunities to move my own investments from things that I consider no longer efficient vehicles for meeting my future consumption needs into more efficient vehicles. It's a good time and a good opportunity to do that. So if I held Fund X and I no longer want to be in Fund X, I want to be in ETF Y, I'm gonna use that opportunity to do it. And I'm also going to take distributions from Fund X, take them in cash, and roll them into ETF Y as we go along. So it's an opportunistic way to make sensible investment decisions.
And I think SPD there, you said from one of your talks, I've listened to quite a bit of your stuff now, Andy and I both have, which is fascinating. But one of them, you said something to the effect of, and obviously correct me if I'm wrong, but the more volatile the market is, maybe that's a time, don't be rebalancing all the time if it's super volatile.
Yeah, if markets are moving around a ton, right, that volatility, it really depends on what your future consumption needs are. But it makes it harder to rebalance when markets are really volatile because the transaction cost associated with that rebalancing is also high. And so it becomes really, really sort of a tricky sort of situation. But those volatile times are also when opportunities are pretty significant, right? So nobody wants crises, but the old adage, right? Don't let a crisis go to waste. That statement is also true. So
I love it. And I know Andy's got a bunch of questions, so I won't go into it, but maybe at some point we'll have you back on and talk about the hidden costs of trading. Sure.
The short version is it's really, really simple. I will tell you what I do over the last, I don't know, years, 5 years longer, maybe. I have transitioned everything that I do from mutual funds into ETFs. They're just so much more efficient. Like the short version is I own no mutual funds anymore, even in my retirement accounts. I just don't do it. They're so much more efficient from a tax perspective, from a cost perspective. It's just, and you can see I'm not the only one. If you go look at data from the Investment Company Institute, over the last 15 years, investors have been running away from mutual funds and into ETFs. And there's a good reason for that. We're not all collectively dumb. So the short version is it really is a no-brainer for average investors. You should be in ETFs.
I think that's awesome. And I think, sort of along the same lines, right? You mentioned that the retirement account, a lot of times an investor looks at it and they have a couple of funds, mutual funds, and then they have a target date fund in there. Yeah. I think there's a temptation to jump in the target date fund, which I think there's time and place for that, absolutely. But maybe any pitfalls you see on that target date fund when they see that as an option, or goodness associated with it.
Yeah.
Prejudge the comment.
Yeah. So target date funds make me gnash my teeth. They're really terrific in some ways, and they're really misleading for investors in another way. So let me talk about the good part first. So how are they really helpful to investors? They're helpful to investors because it promotes saving, right? It forces them to think about those future consumption needs and crystallize them into saving and into thinking about those sorts of things. And they're really simple. They're so straightforward, right? It's not a complicated instrument. Any pilot listening to this can understand it really simply. It's so straightforward. The simplicity is really powerful. Now, what about the other side? Why does it drive me crazy? It drives me crazy because you're fixating on a number and a date. And it's not like your life ends that way. That's not what you want. What you want is post-retirement, post that target date, whatever it is, you want a stream of real income. That's what you want, right? A stream of real income, not even nominal, because now everybody remembers that there's inflation or can be inflation in the world. If we had this conversation 5 years ago, people would roll their eyes and say, yeah, whatever, inflation, I don't care. Now they will listen. So what do you want? Post 65 retirement, you want a stream of real income that supports your lifestyle, whatever it is. That's not what a target date fund gives you. So it's deceptive in a sense that it gives you a false sense of comfort. And that to me is the downside. So, I have this sort of love-hate relationships with target date funds. I understand they make a ton of sense, but investors need to understand how to use them.
Yeah, I would say if you're a pilot and your options are your all United stock in your 401k or target date fund, probably the latter.
Yeah, take the target date fund. You're so much better off. Okay, so let's come back to that retirement thing, because that prompted a thought in my head that I think is actually very useful for pilots to think through and understand. Let's suppose you have those two options on there, right? And you can create a brokerage window in your retirement account to do whatever you want, right? To basically release the hounds. You can do whatever investments you want. So if you're a pilot and you think about what you want in the future, and you've said, okay, I want 20 years worth of living that is, 60% in real terms of what I currently spend per year, per month, whatever, right? That's what you want. That's your consumption goal, so to speak. It's a little spreadsheet. Everybody sits down with their own little spreadsheets or does it in their head if they're really good at it and plans it out. Now, if we get past the asset allocation side and then say, how do I achieve those goals? Well, there are many investment choices that you can make that might be able to achieve those goals. But the best investment choices that achieve those goals after asset allocation are, basically systematic investment vehicles that control what you get in terms of risk and return, that maximize the possibility and the probability that you meet those consumption goals. If you take depending on what the product is, there are some funds and ETFs that are going to be highly, highly speculative, that are going to be incredibly volatile, that might sound incredibly sexy, especially if you're chasing performance, right? So you might go into the ARK fund because it was spectacular. Not so much anymore, right? Versus a systematic product that gives you a series of expected returns that, hopefully meet your consumption goals. And I think that thinking through that is a really important thing for investors. So it's the second leg. It's the leg after asset allocation.
I love it.
Great.
Hey, Andy, this is one selfishly for me. I know you're going to get to it, but kind of thinking about some of those investments that we may take, where would private equity fit in? And what are your thoughts on private equity?
Andy, I think that's directed to you.
Oh, no.
Are you sure?
I think that's for you.
All right, I'll take it. So I think the best way to think about private equity is to think about what risk you're taking. Don't think about the return side. And I think actually, generally speaking, all investors, especially pilots, should always think about risk, not return. It's too easy to think about returns. If you think about risk instead, I think you have a much better framework. So what risk is in private equity? Well, there's a ton of risk in private equity. And one of the most important risks in private equity is illiquidity, right? You can't get your money when you want it. So, if you are going to retire, or if you go through a health issue as a pilot, or your partnership arrangement with your spouse or significant other breaks apart, and et cetera, et cetera. Not having liquidity can be a significant concern. Now, imagine a big sovereign wealth fund, that manages huge amounts of assets. Their horizons are infinite, right? Or really, really long. Even a pension fund has really long horizons. Human beings, most of us, and if you're a pilot in, let's say, your 40s or 50s or 60s even, your horizons are finite. And the risk in private equity gets realized into returns over very long periods of time. 10 years is nothing. It's a drop in the bucket. 20 years is also nothing. So the return that you earn in private equity is over really, really long periods of time. And there is, so in technical terms, we call it, there's skewness in it, but what it really means is that there's like some investments that will pay off a lot, and most of them will not. And the sum, diamonds that you pick up in all of that rock make it look really good, but the realization of those returns requires really long horizons. Honestly, most investors don't have those long horizons. Can you afford to be patient for 25 years, 40 years? For most investors, the answer is no. And there are a whole host of other things associated with private equity that for individuals don't make a lot of sense, honestly. Like, they're expensive. You're going to pay, a lot in fees for accessing private equity. Maybe it makes you feel really good because you can go to your neighbor and say, hey, guess what? We're a golf partner or whatever. I'm in private equity. So maybe it makes you feel really good, but from a financial point of view, for most, I will say, not like ultra high net worth individuals, it doesn't make a ton of sense. It's really, really tough because it sounds exciting, and it is exciting. If you have a 40-year horizon, great, all power to you, go do it. If you have a 20-year horizon, tougher.
Thank you so much. I love it. It's selfish for me. Andy, over to you.
Yeah, I think you mentioned some of the systematic investing, right, and ETF structure. And so I just want to get an opportunity. I know you work with Avantis Fund Investors. I think you're an investor out there and you want to own the market, right? And that's a great place to start. But maybe there's other things you can do in a portfolio to have a little bit higher expected return.
Yeah,
and I think your work is a part of that.
Yeah, what we do at Avantis now almost coming up on a 4-year anniversary, and clients have been very, very happy, and they've rewarded Avantis with giving us the opportunity to manage their capital by very large amounts. So we're very grateful to that. I think those clients are basically responding to the structure and manner in which Avantis portfolios are built. They're built in a they use the latest in financial science, what we know to be true. They do it in a very structured manner. So I refer to them as systematic portfolios because that's what they are. We don't pick individual securities. We know what the drivers of returns, say on the equity side, are. And for us, that's really straightforward. It's a sense of value. So, how cheap or expensive or inexpensive a security is and how profitable it is, the firm is. We use that to think about returns, and then we build portfolios that sort of deliver that, either the whole market or in segments of the market. So these notions, these ideas are drawn from financial science that's been developed over the last 50 years or so. Because those portfolios are so well diversified, for an investor who's planning their horizons, and as I said, their consumption needs, they really improve the odds by which those consumption needs can be met in the future. So they're very systematic, very organized, They're inexpensive because when the funds and ETFs were launched, the goal was to democratize, make it available, and make it easy and make it tax efficient. The tax efficiency part I can't emphasize enough. If you think about when I pay my son's college tuition bill, I don't get to pay it with a return or a Sharpe ratio or anything like that, right? You write a check with real dollars, real after-tax dollars, I might add. So what you want your ETF to deliver to you is, as much after-tax dollars as possible. So, what we've done at Avantis, I think, over the last 4 years is created products that basically do that. The investors can slot into their asset allocations and just help people as much as possive.
That's fantastic. Obviously, the caveat with the taxes there is the 529 type program. But Avantis, full disclosure here, this podcast brought to you by Leading Edge Financial Planning. We work with Avantis. We do not get paid by them. Sunil and Smarty Pants Dance, I think, does get paid by them, but we do not. So just full disclosure there.
Yeah, I think those disclosures are incredibly important. And I think for listeners, the best way to think about this is, dare I say it, go online, go read, do your due diligence.
How dare you?
Yeah, I know. The internet is a dangerous place, but it's such a useful place too. So go online, go read, and you can see exactly what you get, and you can see what the hoopla is about and what it's not about. But we're Avantis is not in the business of creating the next ARC, for example. It's in the business of helping people solve their real financial problems. Delivering solutions that are systematic, that you can stick with and worry about for the long term, better than what I think of as an index fund. Many people, so let's talk about index funds briefly. Do we have a few minutes?
Absolutely.
Oh, yeah.
People love index funds, and I love index funds too. But I think index funds are misunderstood because people think that index funds are passive. They're not. Index funds are created by an index provider. Now, that index provider is suddenly God and decides to change the index, and does it on a regular basis, by the way. So God comes along and every quarter or every year says, oh, this index doesn't look like this anymore, it looks like this. That's not passive. Passive means you hold the entire market portfolio and it never changes. So an index fund is basically an active fund, which means that every fund is an active fund. It's just degrees, shades of gray, if you will. What's good about index funds is that they're cheap. That's great. They have low turnover. That's great. And if I were to compare them to, say, Avantis ETFs, same thing. You see the same characteristics. They're cheap. That's great. Low turnover. That's great. They're all well diversified. That's great. But this notion that everything is, or an index fund is passive is just plain wrong. It's not the case. Nobody creates a truly passive fund. You can't.
I love it. And this is something that, sometimes comes up in the discussion on the flight deck, if you will. And something that is, I try to explain, I don't know if I do it very well, perhaps you have a better answer, but some of the index funds, if you're strictly tracking those index funds per the, like you said, God out there says, hey, you got to buy Tesla. Well, they announce it prior to when it's actually added. So if you're strictly focused on that index and buying as close as you can to have no error from the index, then you're paying higher prices a lot of times, I would say.
You have to. There's no question. And that all that means is that, in technical terms, we call it market clearing. For every buyer, there has to be a seller. That's really all that it is. And if an index fund has to buy a particular security because God determined that security was now in the index, then somebody's got to sell it. And that's only going to happen if there's a give in prices. The seller is only going to give if the buyer is willing to pay more for it, which means that as an index fund holder, you are paying for God's decisions. You have to pay for God's decisions. Now, how much you pay can vary over time and et cetera, but the notion that is zero is just plain wrong. It's mathematically impossible. It's just, again, it's market clearing, and it's hard for people to see that. This is like arcane details in academia and industry now, but most people, I think, can appreciate and understand that, hey, for every buyer, there's got to be a seller. Anytime you see a trade, that's absolutely the case.
I love it. Andy, you got any other questions? I know we've got a million, but
yeah, I know. I think we had some questions maybe a little bit, I don't know, broader, right?
Yeah,
Rob, maybe we'll jump into some of those.
Yeah, here's a question for you, and then we'll get to a couple of ones we throw at most guests, and that is, how do you? Well, actually, I'm gonna circle back. We can cut this out if you want, but one of the questions I did have for you before we get to that is, we talked about consumption smoothing, and that's kind of the strategy, right? We're both military, former military guys, so strategy is consumption smoothing, but how exactly did the tactic work for you when you said, hey, I want to do 7 continents before I get to age 85? What was the tactic you used? Did you stop contributing to your 401k? Or obviously you didn't go into credit card debt. What exactly was the tactic you used to do that?
Yeah, I think it's a question of managing both your current expenditures and future expected expenditures. So you have to do both. It can't just be one. So if I want to hit my 7th continent, I know that's an expensive proposition. Something's got to give, right? Something's got to give either today and or the future. So there's something you're not going to do. I'm not going to rely on my investments to deliver a 30% annualized return for me to be able to do this, because I'm pretty realistic. I know what markets deliver and what they don't deliver, and they do it over long periods of time, not over this next 3-year cycle or 5-year cycle or whatever it is. So I think the tactical answer to do that is, you first think about your consumption decisions, then you make choices consistent with those consumption decisions, and you're going to have to tighten your belt either today or tomorrow or both. And so it's just a question of, what belts are you tightening? What are you not going to do? That people don't like to do that, because nobody likes to tighten their belt, but it's part of life.
I love it. That's perfect. And that's something that a lot of people haven't thought of, or at least a lot of people that I've talked to, which I know the sample size isn't huge there, but they haven't actually thought of, hey, obviously we talk retirement, we talk long-term horizons, but there is a short-term goal perspective that right now there's some great opportunities in short-term investing, but you should probably have a different fund set up just for those, short-term that's not in the market. Those are just, risk or less risky investments to help you go to Antarctica. And I was going to ask you, how did you get to Antarctica? Is there some kind of company that you just fly on, or?
Yeah, there is. So let me, before I go there, the risk side, yeah, I think that's incredibly important, right? So you can have a realization from a fund or whatever, some investment you've made, and then you're planning to consume it within the next 3 months. You don't want to shove it into a highly risky investment if you're planning to consume it in the next 3 months. You want to think carefully about how you do that. As far as Antarctica is concerned, it's actually relatively straightforward. You fly down to the tip of either Chile or Argentina, and then you take a ship across to the continent. You go over the Drake Passage, which is, sometimes they refer to it as the Drake Lake if it's really calm. Remember, there are 3 oceans coming there. Your pilots will know this very well. Or it becomes a washing machine, in which case you're lying flat on your back over the overnight crossing.
Oh, wow.
And then you're there, and then it's an amazing place. It really is. It's an amazing place. It makes you cherish what we have.
Yes. Did you go with your family there?
I did. I do
Oh, that's fantastic.
I mean, this is a holistic thing I think, for us, and actually, I think it ties back to consumption in many ways. So when we think about in academic models, in like arcane models of asset allocation and investment choice and preferences, in academia, we link all of this back to this idea of utility. And most people think, oh, utility, wealth, right? So you go to a wealth manager or a financial advisor and they're looking after your wealth. Not really. They're actually thinking about you as a person more holistically than just about wealth. It's about what you want to achieve in your life, what makes you happy. And what makes you happy is not just wealth. It's part and parcel of it, but it's not just that. I can't climb the mountains now that I used to be able to climb when I was in my 40s, so I did more climbing in my 40s. But I knew that in my 40s, that as time goes by, I'm just not going to be able to climb the sorts of things that I like to be able to climb. And so you do it earlier. So you prepone, right? That idea that investment is about a holistic life, not just a monetary life, is, I think, incredibly important for people to understand.
If I could drop my mic, I can't because it's attached to this crazy arm. I would drop mic right there. That is a huge point that, I don't say it a lot because it gets touchy feely, but that's what, advisors do all the time. That's what we align your values. And then, a lot of people haven't even really necessarily put on paper what their values are and what their purpose in life is. And those fuzzy things, that's what the real thing is. And then the money's just the tool to help you get those things.
The last word you used, tool, is very apropos. That is exactly what it is. It is merely a medium. At the end of your life, or when you look back on your life, what sorts of things are you going to value? And if you can think that far ahead, then you might as well think forward. Ask yourself, what am I going to value over the next 20, 30, 40 years? Is it going to be time with my family? Is it going to be, the next suit I'm buying, or the next piece of jewelry, or the next car, or whatever? And whatever your choices are, so long as they're internally consistent and they're your choices, then your financial decisions are merely a way to satisfy those choices. And different people have different sets of choices. That's fine. That's great.
Yeah, I love it. It's Morgan Housel. I think he's the one who says it. Something to the effect of, "Hey, what makes me sleep better at night isn't what makes you sleep better at night." And same for the fun out there. I love it.
Yeah.
We've talked a lot about different things. Just personally, if you don't mind answering, how do you personally invest, or what do you recommend to your kids when it comes to investing?
My kids started investing when they were probably 14 years old, I think 13 or 14 years old. They're now in their early 20s. One is still in college. The other one's graduated from college. So they've invested for a long time. This will not come as a shock to you. Their asset allocation plans are incredibly simple. They are 100% equity.
Yes.
And they basically don't touch anything they invest, and they invest both gifts that they get from their grandparents, for example, but also their own, money that they earn from internships or this job or that job or a scholarship or whatever it is. So it's 100% equity. This also won't come as a surprise to you. They basically own 3 Avantis ETFs, maybe 4 Avantis ETFs. They're broadly diversified. So they own the US market, that's AVUS. They own small value, I think that's AVUV. They own emerging markets, and they own developed markets. So basically, they own the market portfolio with the tilts in a very tax efficient manner. And they're not going to touch those for probably another 30, 40 years.
Love it.
The power of compounding is phenomenal. Systematic compounding over long periods of time is just phenomenal. And they kind of, to their credit, they already get it. They understand. That's not always the case because it's easy to chase the shiny object, but they get it. And I think my wife and I, our personal investments are very similar. So here's another way to say this. My job, because I'm a professor, my job is a bond, right? I'm a tenured professor. So my human income is basically my human capital is just like a bond. I get paid every year, and it's hard to fire me, and hopefully never doesn't happen. So I already own a bond, right? So why would I invest in fixed income? It serves no purpose for me because I think about the whole portfolio. So all of my investments go straight into the equity market. I don't touch anything else. Basically go into the same thing my kids are in. It's just simple. It's not complicated. Leave it alone for 20, 30, whatever years, and it'll be fine.
I love it. I love it. Is there anything we didn't touch on that you're like, hey, I wish we went a little more in this direction before we wrap up with some...
I don't know the degree to which clients are, pilots are inundated with things about separately managed accounts or direct indexing or things of that nature. But
not much from what I've heard, but yeah.
Okay, so then I don't think we need to go down that road. That's the only other thing that occurred to me that, if they're inundated with that, then we should probably talk about that. But other than that, I think it's a pretty holistic conversation. I think they should feel good about it.
Sounds good. I absolutely was thrilled to have it. Before we let you go, any books you recommend for folks, generally speaking, investment related, life related, whatever?
I will tell you what I like to read are things that challenge my way of thinking for good or bad. So I'm the sort of academic who has, generally speaking, I try to be as open-minded as possible. But at least when it comes to financial markets, I think of market participants like the pilots we're probably talking to as pretty rational people who think carefully about their decisions. Like when you buy a house is one of the biggest investment decisions most people make in their lives. So you know what? They're going to be pretty careful. They ought to be pretty careful about them, right? So I think of most such people as being pretty rational. But many of my colleagues in the profession disagree and don't. And I really appreciate and like their work because it forces me to come to grips with my own set of beliefs. So for example, I often enjoy reading Danny Kahneman's books like Thinking Fast and Thinking Slow that I think a lot of your pilots have probably read. Or Bob Schiller's books. Animal Spirits, I think, is a terrific book. Even if I don't agree with them, I enjoy reading them because it forces me to confront my own biases. I really like that. When I think about sort of life holistically and the unfolding of life and the sorts of things you might care about, both looking forward and looking backward in your life. I actually don't enjoy looking backward in life. I think it doesn't do us any good. It doesn't do me any good. So I always try to look forward. But Khalil Gibran has a very famous poem from a long, long time ago called "The Prophet." It's a terrific poem. It's broken up into chapters that deal with things like love and marriage and eating and giving. All of the things that are central to our life, but there are little truisms in each of those little chapters that they resonate with me because they force me to think about, do I really want to do this? And if so, how should I do it? How should I articulate these desires?
Fantastic. And you kind of touched on this, but maybe if you have anything else to add, what is success to you?
So for me, I like a very holistic life. To me, it's not about financial success. It's not about career. They can be inputs. career success, financial success, family success, etc. It's all of those things. So I care a ton about, my family, my extended family, my immediate family, their happiness, their well-being. I care a lot about, the things that I know give me a lot of pleasure, being outdoors, things of that nature. I have a partner. We've been together for a long, long time, and we plan to be together forever. So these sorts of things define success. If you know what you want, I'll come back to the beginning when I said know thyself. If you know yourself, then you know what you're trying to achieve, and everything else sort of falls in place. So for me, it's very holistic. It's all of those things put together in judicious proportions, not one to the exclusion of the other.
That's fantastic. And just words to live by right there. This has been a true pleasure. It really has. And, we've had some guests on that are better than others. And this is one of the better ones for sure. So thank you so much, Sunil, for joining us. You may or may not be getting a plaque that says something to the effect of Pilot Money Guys, Smarty Pants Dance. Hang it right next to your PhD. I don't know, whatever you want to do.
That's a big idea. I have a friend who's a pilot for Air Canada. I'm gonna forward this link to him and say, hey, don't laugh when you listen to this.
I love it. Well, thanks again for sharing all your insight. Maybe at some point we could have you back on if it wasn't too miserable, but I know you're a super busy guy. So thank you for joining us on this one.
Thank you.
It was my pleasure. Happy to do it, and I'm happy to circle back and talk about more detailed things if you want.
I love it. All right. A couple of quotes for you to ponder on your drive or your flight or commute. I think the good doctor here will agree with these, but these are from Benjamin Graham. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. That was a mouthful, sorry. And then the second one is thousands of people have tried, and the evidence is clear. The more you trade, the less you keep. Again, Benjamin Graham. That's it. Let us be the first to welcome you to the final destination of Flight 65, Pilot Finance with Dr. Sunil Wahal, Smarty Pants Dance. Did you learn anything from this free podcast? If so, pay it forward and tell someone about it. Or at least leave us a review, good or bad. We take them all, and we've had a couple bad ones, so that's good. We aim to make the world a better stewards of their money. Help us out. Please shoot us any questions you would like us to cover. And remember, as Emerson said, the world makes way for those who know where they are going. And as we say, so plan accordingly. From all of us at the Pilot Money Guys, we wish you smooth rides and soft in the zone landings.
Thank you for listening to the Pilot Money Guys podcast. It has been our pleasure to share some information with you today. Give us a call to discuss absolutely any investment question you may have. Click on the subscribe button below to be notified when new episodes become available. Visit leadingedgeplanning.com to learn more. Take care.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.